Hey, what's up everyone? Hope you're having a great day. My name is Corey Lane from TradersArmy.com. Today I'm going to walk you through a platform tutorial. This is the Thinkorswim platform, and this tutorial is going to be based upon building a credit spread, a bullish credit spread with entry and exit brackets so we can take a hands-off approach when trading this style. So for this example, I'm going to use the IWM, which is the Russell 2000 ETF. And as of recently, we've seen the market kind of pull back and drop a little bit, but still kind of showing very bullish strength, a lot of bullish strength off of this area of support. So this is my motivation behind wanting to sell this credit spread. I'm expecting prices over the next 8 week roughly, maybe a little more, to continue to push higher, potentially even break this high at 164.25 roughly. So that's my motivation for using a bullish spread. Now the spread that I've chosen is the to sell the 156 puts and buy the 153 puts. And I'm going to add this little commentary here. I am not, this is not a tutorial on my motivation for why I'm picking these strike prices. This is just how to set up the actual order. If you want to learn more about actually establishing a higher probability credit spread, whether it's a bullish credit spread or bearish credit spread, you can refer back to some of our tutorials that we have and lessons that we have on building actual credit spreads from the ground up for, when and why we would want to use this type of strategy. This is just order entry. So this is the trade that I've chose, short the 156 puts, long the 153 puts. These expire in 8 calendar days. Right now, this credit spread is quoting around 45 cents credit, and this is enough for me to go ahead and sell this credit spread. I look for about 15% of the width of the spread, and I'm getting that in this trade, which if the price drops below our short strike at 156 by, greater than 10 cents below that short strike, we have a stop loss that we're going to place that'll get us out for around a $70 to maybe $75 loss if this stop is hit very soon relative to entry. And so I want to have that stop loss in because the risk on this is $3 total, because that's the width of the spread, minus the 45-cent credit, which means our risk in this trade, if we don't have a protective stop, is a full $2.55 per share, or $255 a contract. So the risk reward, if we do nothing and risk the full $255 to make 45 bucks, the risk reward does not make sense at all. So I want to manage that risk to lose less than the $255 if I can help it. And my whole motivation for wanting to sell this spread is I believe that IWM will stay above 156 support level. And so if it breaks below that support level, then I want to be out. It's quite simple. But also, if we're collecting 45-cent credit, I want to actually buy back for a profit. If I can close this trade out before it expires for near max profit, I want to go ahead and do that as well and not, hang out the whole length of expiration, because it ties up unnecessary buying power. And the market could reverse in the last day or two. So if I get an opportunity to close it out for near max profit, I'm going to do that. So I want to place that all in one order. So I do all my analyzing under the Analyze tab. But then when I'm done analyzing and I'm ready to place the trade, I simply right-click and I create a duplicate order anywhere on that order. Now, we're going to have to change this from advanced order, which is just a single order to enter, and that's it, to what I'm going to be using, which is first triggers OCO. So it stands for order cancels order. And then these two orders that I'm going to have waiting after the entry are going to be the opposite of the entry to close the position if something happens. So I can right click anywhere on the entry order and I can create an opposite order, and that'll create one closing order. Well, I need two closing orders, so I'm going to do that again. And now I have two closing orders, both of which will be waiting time and force good till canceled. Okay, one of which I will say, if I could buy this entire spread back for 5 cents limit, that is, I'm willing to buy the spread, but I'm only willing to pay 5 cents or less, then that means if we can sell it for 46 and buy it back for 5, we keep the other 41 cents as realized profit. So that's what I mean by taking a profit if we can buy this back for a lot cheaper. So you can put any dollar amount that you want in there, less than 46. Some people will say, I'll take 50%, of my profit potential. So they would close it out for 23 cents. Some people take 80%. Some people go 90%. Some people just put it in for 5 or 10 cents always, no matter how much they got. But how much you want to buy back the spread for, that's up to you and your plan. For me, I like to buy it back for around 80 to 90% of my profit potential. So this would get us in the neighborhood at about a nickel. Now, for the stop loss, we're actually going to trigger the stop loss off of the stock itself going below 155.90. In order to do that, I have to come over here on the closing order, and I'm looking to modify the conditions or add conditions. So I'm going to click on this little cog over here, this gear on the far right, and that opens up an order rules box. You've seen this in some of our other tutorials, so it's pretty straightforward. There are 3 sections to the order rules box. The upper section is the order itself. The middle section are the conditions under which you would want to send the above order. And then below is a plain English description of what it is that you're establishing and your conditions and your order. So the order is already set up. We want to buy the spread back to close it, but we want to set up the conditions. And I'm going to go under here under symbol, and I'm just going to left click under the symbol, and it drops in IWM automatically for me because that's the stock we're working on. The method, so the mark price is the mid price of IWM. If that's ever less than 155.90, and I just type in where my protective stop is going to be. So if IWM ever goes below 155.90, we want out of the position. Okay? And now it would send the above order. Now with something like the IWM, it's a very liquid ETF. I would feel very comfortable just placing a market order to close IWM. The bid-ask spread is not very wide. It's usually a penny or two, maybe 3 pennies wide. So a market order is not going to experience too much slippage, if you will. But to get more fancy with it, you could say, I don't want to pay the market price if I can help it. I'd rather pay a defined limit price. The problem is we don't know what the spread is going to be worth exactly at the time our stop is getting hit. So one neat little trick that Thinkorswim can do, and I've shown this in a bunch of different tutorials, but I'll show it again, is we can keep this limit, okay? But instead of limit linked to MAN, we want to limit, we want that link to limit to the mark price. So that's the mid price of the bull put option spread. So when I change that to mark, notice it changes this limit to limit offset. So we can go plus or minus. So how we're going to use this is basically by setting it up to mark against the limit. You're saying if IWM is ever below 155.90, find the mid price or the mark price of this bullish put spread and enter a limit order to close at the mid price. Now, that has a high probability of getting filled because we're right at the mid price. We're not at the market price. But if the mid price is really close to the market price, then you're going to get filled. But if you want to improve the probability of getting filled, then we can offset this in the direction that would that would improve the probability of getting the trade filled. And so since we're buying to close this spread trade, then we would want to offset by increasing this by I usually look down here at the difference between the mid and the natural price, and if that's 2 pennies wide, then I'll just go ahead and bump it up by half that. If that spread were 5 pennies wide, I would bump it up by roughly half that. If the spread were 30 cents wide between the mid and the natural, then I would bump it up by, again, about half of that. So we're basically meeting in the middle. We're saying, I know it's going to be a tough to fill at the mid price, but I'm willing to pay 15 cents above the mid price to close this trade. So in this case, because there's such narrow spreads, we can just keep it at a penny. Honestly, this would probably fill at the mid price, but we'll go 1 penny because we are going to want out pretty desperately if it hits our stop loss. So we'll click save on that. And this is just a 1 contract trade, just to kind of show the setup here. But if we were to confirm and send this, we can see the vertical spread is going to pay us 46 bucks. Let's actually double check. Is that the current price? Oh, it's 45. We should have stayed at 46. I'll bump it back up to 46. We'll confirm and send it, and we'll read this. This is our confirmation box. So we want to sell this put spread if we can get 46 cents or better for it. If we get into that trade, we'll go ahead and have an order standing by and waiting to fill. If we can buy it for 5 cents or better, that would be our near max profit potential. And then the other order is also waiting to buy back 1 penny above the mid price if IWM is ever at or below 155.90, which is our protective stop. So because we have this set up as a first triggers OCO, these two buy orders will be waiting as a bracket. And if I go ahead and send that, and I come over to the monitor tab, you can see our order waiting here. So this shows we're looking to enter. That's the key order. And if that order fills, it would then send the bracket. So you can see visually these brackets for the closing orders. And this way, if we get filled on this trade and we enter, we don't have to hang around the computer or hang around, your mobile device waiting for things to happen. The system will automatically now close the trade, or you'll just stay in the trade all the way through expiration. So if it doesn't close it out for a loss or a profit before it expires, then that means it's staying above 156 and we can go about our day and just appreciate that those orders are waiting. So if you have any questions on any of this, guys, please don't hesitate to reach out, support@tradersarmy.com, or you could always text us. And our text number is 973-348-5022. You can find this number anywhere on our website in the top left-hand corner. And you can text us if you have any questions, comments, or concerns about anything. So we look forward to hearing from you. I hope you enjoyed it. Have a great day, and we'll talk to you later. Bye-bye.